Good morning, guys. And today we'll be talking about premium equilibrium and discounts, perfectly balanced as all things should be. Premium and discount zones are foundational concepts within the trading world, offering traders a powerful framework to identify when an asset is either overvalued or undervalued. So when an asset is being sold at a premium at an higher price more than a fair value, that's been overvalued, that's premium. And when it's been sold below a fair value, that's it's been undervalued and that's discount. So for understanding premium and discount zone, it's important to understand equilibrium levels. It is also known as basic or fair value. So for our topic, equilibrium is the midpoint of a given price range. It's a reference point for dividing the price range into premium and discount zone. So within a given price leg, within a swinger and a swing low, the midpoint of that price move or that price leg is the equilibrium. So that's the midpoint. Let's say from 0 to 2. From 0 to 2, price moves from 0 to 2, then the midpoint which is 1. That is the equilibrium point. So the equilibrium represents the fair value of the price over the range being considered. Yes. For you to have pick out equilibrium, you must clearly define a range. So, and then the midpoint will now be the fair value. Traders use this as a benchmark to decide whether the current price is in a premium or a discount zone. Above the equilibrium level is a premium level, and smart money employs this to find potential sell entries. So in the premium zone, it's easier to find potential sell entries, especially if we consider a price leg and we consider a particular trend. So if it's an uptrend, if it's a downtrend and then price retraces back to the premium level, smart money will employ this to find potential sell entries. Then below the equilibrium level is the discount zone. Smart money employs it to find potential buy entries. So below the equilibrium level, we have the discount zone where we expect that within this price leg, the price is undervalued. The price of an asset is undervalued. So if we are like in an uptrend and then we retrace to the discount zone, smart money will employ this in finding potential buy entries. So this is an example of a particular price move where price moves from $0 to $9 and the midpoint which is $4.50. That is the equilibrium level. So above it, from that $4.50 and above to $9, that's premium. While below it, from $4.50 back to $0, that is the discount zone. So if price falls into the discount zone, we can smart money and traders can use this to find like potential buy entries. And if the price go above $4.50 and into the premium zone, smart money use this to find potential sell entries. So, talking about the premium zone now, this zone is identified by drawing the Fibonacci retracement tool. So you can find this in TradingView or most chart analytic apps. They have it. The Fibonacci retracement tool from the swing high to the swing low of a particular price range. The area above the 50% retracement level, that's the 50% retracement level is the equilibrium level. So the area above this is considered the premium zone. When price enters the zone, it indicates a potential opportunities for traders to sell. And this doesn't mean that whenever we enter premium level, we should start seeing sales. There are lots of things you also incorporate into this. You don't just pick, oh, enter premium and then keep selling, selling, selling. There are times when price may have done, they have performed their objective, they have like taking out the liquidity point, and then it's will not going to go into sales from that premium zone. It will just go out and take out the swing guy or the holder. So in this type of scenario, you have to incorporate your daily bias and the other things that have been taught in this mentorship for you to just pick out, okay, this is a potential opportunity for sale. But overall, if you are looking for sales, premium zone is a very good place to look for sales. So potential premium arrays or structures in a premium zone. In a premium zone, you are going to find the old eye, you're going to see rejection block, bearish order blocks, fair value gaps, most likely the CB, that's the CB, the liquidity voids, the bearish breaker, and the bearish mitigation blocks. These are potential sell structures or potential premium arrays you are going to find in the premium zone to pay yourselves to. So price can retrace to a bearish mitigation block, a bearish breaker, balance and imbalance that's filling a liquidity void or fair value gap, retrace to a bearish breaker, a rejection block, or at the very end, the swing guy, that's the old eye. So talking about the discount zone now, same thing. This is identified by drawing the fib retracement tool from the swing high to the swing low of a significant price range. The area below the 50% retracement level, which is the equilibrium level, is considered the discount zone. When price enters this zone, it signifies a potential buying opportunity. And like I said before, for the premium zone, it doesn't mean that every price leg then you draw 50%. You draw look for the distance count zone and then you only buy. You have to pay with all other things. You have to pay with your buyers, you have to pay with liquidity, find out on a larger time frame as a particular liquidity objective being met, a particular imbalance being rebalanced. So you don't just look for every price leg and then put your fib retracement and then look for only discount then buy. No. There has to be other undertones that you have to also follow. But in a potential uptrend, discount zone is a very good opportunity. Whenever price retraces to the discount zone and the particular long-term objective as a liquidity point or a particular imbalance hasn't been rebalanced, then it's a potential opportunity to buy. Price retracing into discount, then you looking for potential buying opportunities, tagging it, and then price moving away from that direction. And likewise, potential discount arrays or structures in a discount zone includes the bullish mitigation block, the bullish breaker, the liquidity void, that's a BC now, the BC, a fair value gap BC, then bullish order block, rejection block, and then a no low. So these are bullish or potential buying structures, potential discount structures you're going to see in a discount zone. So any of these, price can meet any of these, hit any of these, and then create a buying opportunity, and then price will move in the other direction. So looking at it pictorially, this is like from that old high to that old low. That is how price like array. So from the old high, then the rejection block down to that. So the the zone where they divide, that midpoint is the equilibrium point. So we enter the discount zone now, we go into the premium zone. So in the premium zone you look for sell opportunities, and in the discount zone you look for buying opportunities. So talking about the importance of range high and lows, The effectiveness of the premium and discount zone is rooted in the range defined by the high and low points of the price movement. So you can never ever find premium, equilibrium, or discount without having a defined range. So if you don't have a defined range, it's not possible to be looking for premium, equilibrium, or discount. You can't just pick a point. It must be between a particular range, price range. So this range help traders determine where to expect premium and discount. An easy way to visualize a range is to identify areas where external range, sell side and buy side liquidity are resting. That's like an easy way. So if you go back to our liquidity lectures, you're going to see how we define external range, sell side and buy side liquidity. So with this, you can look for a particular point, define your range there, and then work on that. When you define your range with this, then you always get the equilibrium point, and then the premium and discount zones will definitely come out. So finally, while trading the premium and discount zone, short position in the premium zone. Trading short position in the premium zone offers a better reward to risk ratio than trading at the equilibrium or in the discount. So most traders, if they define a range high or low, most of the stop loss reside in the range high for sells, and most of the stop loss reside in the range lows for buy. So if you define this range and then you are selling at the premium zone, you are selling in the premium zone, then stop loss will most likely be at the range high. So that way, if you are offside, if you are wrong or you are offside with your analysis with your trade, it's still closer. Your stop loss is still closer, so you won't be risking much, and you'll be able to take more trades that have better RR, risk reward ratio, than taking it at the 50% equilibrium level or taking a short position in the discount. So it's easier and it's effective taking short positions in the premium zone than even in the discount or in the equilibrium point. This is because price in the premium zone are considered overvalued, increasing the likelihood of a downward correction. If you are taking short position in the discount zone, price is still considered undervalued, so there is still potential that price will still rebound, can still rebound and go up more into the premium, or even take out an order. So your RR is going to fall when taking short positions in the discount zone. So that's why premium zones is better in taking short position. And it's even extendable to the lower time frame. When we get to the next part of this pre-D lectures, then we are going to be carrying out the practical aspect of it where you're going to see how it is. And long position in the discount zone. Similarly, long position in the discount zone provides a better RR than buying at equilibrium or in the premium. Buying at equilibrium or in the premium, it's not advisable. Look for your trade long positions at the discount zone where you have better RR, where even if you're outside, it's closer to your stop loss. It's closer to your stop loss. I would rather prefer a trade that if I'm outside, it takes me out rather than, let's say I'm taking a long position in the discount zone and then price now keeps retracing back to that. And taking long positions in the premium zone and then price now keeps retracing to the discount zone. The amount of hits I'm going to take. Maybe price eventually didn't take out the old low and then it rebounds. But the amount of hits I'm going to be facing during those times will be much. And as beginner traders, it's something you might not have the mental fortitude to do. It's something you might not have the mental fortitude to do. So it's always better. It's always better. You just take your long positions in the discount zone. And if you miss it, Remember, there are other opportunities. It doesn't mean, oh, since I missed this particular trade, I'm never going to get another one again. No. There are other opportunities. There will still be other opportunities that will appear. There will still be other trades. The market will still keep going on. So sometimes you see traders beating themselves up for missing a move in the discount zone, and then they'll now fear of missing out, FOMO, fear of missing out, and then they'll jump into the trade in the premium, and then they get skewered. So please, till next time, folks. Have a lovely day.